Hello and welcome to the latest edition of Captive Review's virtual symposium series. My name is Nick Morgan and I am the publisher of Captive Review. We launched this series just 8 days after the UK government applied the initial restrictions due to COVID back in March. And I think, unfortunately, to some degree, we plan to continue this virtual format right through until at least the spring of next year. One thing we clearly know from this time that we've done is that lowering the barrier to enter by removing the need to travel or time out of the office has certainly bolstered the numbers we've attracted to people being able to gauge our content. And this is no exception. So we've got a great group of people here today, and I'd like to thank everyone for joining us. I'd first like to say anyone who's used this service with us before will know that we use Slido, which is at slido.com, slido.com, and that is for all the questions and answers. But also importantly, we'd like to do a quick poll at the start. So when you go to slido.com, and if you could all do that now as well, you'll see on the left-hand side, join as a participant. If you enter the hashtag Captive Review, that will show the answers to the poll that you have. So I just want to thank our host for today, which is going to be Carolyn Fahy, who she and I met on a shuttle bus at the Vermont conference 2 or 3 years back. Of course, something you can't do in a virtual format. So I'd like to thank you very much for once again from AirRock joining and moderating today. And of course, thank you for our sponsors, which are R&Q, Milliman and Sirius Global Solutions. I'll be back at the end with some of the questions and answers you've had. But for now, Carolyn, it's over to you.
Thanks so much, Nick. Really very much appreciated. We were joking a little bit before this about the fact that Nick and I met on the bus in the morning. It was not the party bus. I think we had coffee in hand at that point in time, and it was more just, we just started talking and we hadn't met each other. So it was fortuitous, and the relationship has certainly blossomed since then, and we're pleased to do more and more with Captive Review.
Great.
So I'll
drop off now and see you at the end.
Thanks, Nick. So I'm going to remind everybody the Slido, slido.com. As Nick mentioned, we are starting this off today with a couple of questions just to sort of get the baseline as far as how much everybody knows about Runoff and the captive realm. But while you guys are answering that question, I'm going to turn it over and ask each of my 3 panelists today to introduce themselves. And we'll start with Derek Jones, Principal and Consulting Actuary with Milliman.
Good morning, everyone. As Carolyn says, I'm Derek Jones. I'm an actuary at Milliman, where I co-manage the property casualty practice in our New York office. We're pretty active in the captive and alternative risk transfer space, commonly helping companies with feasibility studies as well as pricing, reserving support once they've been formed. So we're pleased to chat to the captive world this morning.
Great, thanks, Derek. Mike, why don't we go next to you?
Good morning and good afternoon. I'm Mike Terelmus. I am the Chief Financial Officer of Sirius Global Solutions. Sirius provides exit strategies to folks in the insurance, reinsurance, captive, risk retention group world through a variety of mechanisms, some of which we'll be talking about today. Apparently they got a picture of my younger brother on the slide because this little thing here came along as COVID. It's the same guy, believe me. So there you go. Yeah. So anyways, yeah, I'm the same guy. Who knows what'll happen with this after COVID? But anyways, pleasure to be with you all, and look forward to the conversation.
All right. And last but not least, Stuart.
Well, thank you. Good morning, good afternoon, everyone. I'm Stuart Ritchie. I'm the CEO of R&Q Re Bermuda, which is R&Q's primary legacy vehicle that we have in Bermuda. I joined R&Q. I'm a relative newbie, joined back in June of 2019 as an SVP in their legacy M&A team. Before that, I'd spent almost 15 years with PricewaterhouseCoopers in Bermuda in their insurance audit and advisory practice, in which a significant portion of my time actually was auditing and advising captives. because Bermuda's, I think, still the largest captive domicile in the world. So good captive background that I have, and yeah, I'm excited to be offering legacy solutions to people who have existing captives. So looking forward to a good dialogue today.
Okay, great, thank you. So Melissa, maybe we can turn to the responses to our questions that are hopefully coming in. Okay, so a little bit mixed. 53% have not participated in a legacy transaction. Okay, that's a good audience for us. What about the other question, just sort of with a baseline on the understanding of the definitions of runoff? Okay. All right, good. Well, then it looks like we've got a lot to teach everybody, right? So let's just move on to the slide there that gives us a little bit of perspective on the size of the runoff market. So I always like to start here. I think that one thing that people often don't realize is the size of the runoff market and how it is really underpinning a lot of the insurance industry as a whole, and allowing the insurance industry to serve what the purpose is that they're supposed to do in creating new lines of business as we in society change and need those. These numbers are from a PwC survey that we partner with AIRROC and IRLA, the Insurance Reinsurance Legacy Association. This is a pretty big number if you look at it. And there's a common misperception, I think, among that runoff is companies that really literally are sort of at the end of the line, will soon be ending their business, which of course you can see here is very far from the truth. It's a growing market. This number right here in 2019 is actually up 8% over what was the number in 2018. And there's really a lot of good data in this survey in general about the market, about different levels of board engagement in the market and lines of business. So I would really encourage you to take a look at the full survey if you want to learn more. And looking at this a little bit, you know, the runoff market has really evolved a lot over time, and all of our panelists have been involved in it for quite some time. So, you know, Stuart, can I ask you first to comment a little bit about how you've kind of seen the evolution of the runoff market?
Yeah, we've given that R&Q started as a legacy player back in 1991, and I think to your point, Carolyn, I think back in those initial days, anybody looking for a legacy solution probably was as a result of being a company that was in trouble and didn't have sufficient capital to pay the remaining liabilities. I think that definitely has changed. We're now beginning to see, and I think we have seen over the last number of years, that it's become a much more acceptable mechanism for capital management strategy, to be blunt. I think there's a lot of captives, in particular when they will look at this, that maybe have some third-party liabilities on their books, maybe because they were trying to get that third-party business to assist with their kind of tax structuring, but clearly looking for exit solutions on that. How do they free up capital? And so there's definitely an evolution there, but we're also seeing some of the large commercial insurers and reinsurers now looking for kind of capital management strategies which involve some degree of legacy solutions. And I know we talk about the types of solutions a little later, but yeah, we're definitely beginning to see just a general acceptance in the marketplace that these are not solutions for failed businesses, but they are actually very strong capital management tools.
Yep, all good points. Mike?
Yeah, it's very. I'm gonna mirror what Stuart said in the fact that just in the name of what we call ourselves. For the longest time we were called Runoff. Now we have the term legacy kind of creep in, and it's almost it represents a shift in, I think, the motivation of the sellers, of the folks that are looking for the product, but also a shift in the entire product as a whole. Back in the late 90s when we started up in this space, it was essentially people looking for an exit strategy because they had made horrible underwriting decisions. Now we see books of business that are actually very profitable entering into the runoff space. And even more so, under the COVID world, we've seen people that are, taking very profitable books of business and looking to monetize them or create additional cash flows with them. So a whole different model that's out there now than what was there historically.
Good. Anything to add, Derek?
No, I mean, I think as we get to the next slide, I think it just sort of supports the same thoughts. I think we'll talk a little bit about sort of what's in that reinsurance market, runoff market.
Yeah, can we go to the next slide, Melissa?
And so, I think very much to Stuart Michael's points, when you think about what's in the runoff market, certainly there's some part of what's here that is, a function of mistakes. There's just business that you're not going to underwrite any longer, and you need to move on. So you need some protection from further deterioration. But I think today, as the guys point to, a fair amount of what's in the runoff market is really a strategic decision, and often sort of a positive option. A decision, just from a operational perspective, what business is really core to our how a company works. I think you do get certain situations where following an acquisition, the parent may have a different view of where they want to go, and so certain business is wound down. It's put into a silo unto itself. It's discontinued. But I think there are other opportunities to get some relief. Stuart talked to the capital management. I think there are places where you find millions of dollars that are just tied up, and if you could find a partner to help you get some relief, I think the legacy market offers a nice opportunity for good capital management.
Yep, for sure. And just so the audience knows, pretty much all those definitions that you see there are definitions of runoff or legacy. So one of the things that's important to note in this is that the definitions of legacy can be as varied as the companies that are in the space. It can be anything from really, really old, decades old, long tail books of business. Asbestos is one of the big ones in the space, up to something that's really relatively new, a cyber risk perhaps, that an insurer decided that it's not going to be beneficial to them and their policyholders, so they've decided to discontinue writing it. At AROC, we always say yesterday's underwriting is today's legacy. So really, I think that pretty much sums it up quite well. I don't know if any of the other panelists wanted to add a little bit more to the definitions.
No, I think the definitions are relatively kind of easy to understand. I think just in the context of a captive, I think the ones that I certainly had a lot of experience kind of auditing in my PwC days, primarily they did property policies, and then invariably there was a kind of deductible workers' comp, AL, GL type policy, or a combination of them. Now, ultimately, some of that, the tail on those workers' comp, AL, and GL policies can quite often be 10, 15 years, and maybe there's still a number of kind of claims that's open there. But that's all just effectively tying up not just the capital that's in the company, but it needs to be managed, right? So you have TPAs where you're still paying costs for those. You're still subject to audit of those numbers. So I think to some extent, as you start looking at why would you maybe look at a runoff solution or a legacy solution, part of it should be, what have I got on my books right now? What is it doing for me? Is there a way of kind of looking at how do I clean up my balance sheet that brings some degree of finality, and that invariably has some kind of cost benefit?
Yeah, it's a great point, Stuart. And one of the things that's also we see in the captive space, especially, you don't see it necessarily in other areas, is where you've got two parent companies that merge together, and you end up with two captives that are essentially doing the same thing. You don't need that, and so you end up with two expense structures that are there, a bunch of capital that's tied up, and while there's not rating agency capital necessarily that's tied up in the captive space, having that capital that could be deployed elsewhere in the parent company or could be deployed to perhaps write other lines of business for the captive, oftentimes going to your own reserves as a source of capital is a way that you can expand your business and or create some excess capital that you can return to the parent company.
That's a great point. And if I can, Carolyn, I'll follow on a little, because I'm kind of conscious that some of the audience, if they're risk managers, captive managers, will be looking and saying, well, actually, my capital requirements in a captive are generally fairly light. I don't have to put up a lot of capital to support these things because it's not risk-based the way that commercial insurers are. The key thing here is that a large number of captives will actually be posting collateral. And it's quite often the collateral that's tied up on your reinsurance program that actually is the binding constraint. So if I have $10 million of liabilities and my fronting insurers require me to collateralize that to 200%, then effectively I'm tying up that an additional $10 million in my captive, that I could look at a legacy solution to free up some of that. Yes, I may have to pay a premium, but I can get off risk. I can get that trapped capital collateral out of the vehicle, and it's better deployed within the captive for another line of business, or repatriated back to the parent company. So it may well be that somebody's listening and saying, well, I don't have a big capital requirement. I maybe post an LLC in Vermont, or I have a 120,000 in Bermuda and whatnot. But I think to most captives' point, it's usually the collateral that's posted in support of the reinsurance obligations that is what is tied up within the captive.
Okay, moving on to the next one. I don't know, we probably won't dwell on this too much. This just it kind of shows the diversity. Pretty much really, in essence, all insurance companies have some type of runoff. And they manage it different ways. They can keep it in-house. They can outsource it, as some of what we're talking about a little bit here is you can do a transaction with one of the runoff acquirers or providers to completely take it off your books. So this just sort of gives a different flavor to the fact that all the different types of companies that we're all familiar with in this market, they're all players in this space. They all have runoff, and they could all avail themselves of the opportunities.
Yeah, one of the great examples, Carolyn, if you think about AIG effectively put all their legacy, or a significant portion of their legacy, right, liabilities, both on the P&C, the non-life as well as the life side, into a separate vehicle, which I believe they've kind of sold, at least if not a majority shareholding's gone to Carlyle and another kind of backer. But ultimately, you are starting to see that there's an acceptance within even the largest of the insurers and reinsurers that there is this needs to be separately managed, and that by putting it into a distinct vehicle, there's an appetite there for people who wish to invest in those types of vehicles as well.
And speaking of that, Stuart, there is now, when we started this, back 20 years ago, there wasn't a whole lot of folks out there that were in this space. And now there's a large appetite for people that want to acquire these liabilities. And so, in speaking to your brokers or whoever would be your contact people, you'll find that there is an appetite across the board. Obviously, R&Q and Sirius are represented here, but there's a bunch of folks out there that have lots of capital to spend on this. And that's probably one of the things that I've seen as a shift. Early on, there were just a few players, but the influx of capital, there are people that are definitely willing and interested in expanding in this space.
Yeah, I fully agree. I think for people who are listening to the conversation, they shouldn't think that, oh, I only have $5-10 million of liabilities, or 50 million. Whatever. There is a market out there, whether that's the reasonably small players, larger players. The only thing I think we would probably, Michael, you and I would probably agree with, is that they should have at least some kind of salt and pepper beard before you want to do any transaction with them.
Well, I dye mine, so that's But yeah, and it's a good point. The fact that there's a market out there for almost every appetite. We get transactions in that are typically, you know, sometimes we'll see, you know, $500,000 transactions. Those are a little bit on the small side for us. But there are folks that I actually reach out to and say, hey, there's this opportunity. You guys might be interested. And they've got both the expertise and the appetite to underwrite those type of transactions. And then on the, you know, the other end of the spectrum, there are transactions that are, you know, that are quite large. And there's an appetite out there across the spectrum.
Yeah, and even really within the AROC membership itself, you know, which is a corporate level membership. So for those of you who aren't as familiar with AROC, the company joins, and then obviously all the individuals within the company are the ones who attend the meetings. And anywhere from, you know, Fortitude, as you mentioned, Stuart, to, you know, we've got really big companies that are involved that are managing in-house to setting up separate companies to do it, all the way to small companies. So, you know, truly there's a lot of expertise there as you're looking at various types of transactions. And it's a little bit of a dance to sort of find the right partner to make, you know, make it successful on, you know, for all parties.
I'd agree.
So let's go on and delve a little bit more into the reasons that a captive might want to consider a legacy or runoff transaction. Melissa, if we could go on to the next slide. We're going to see here a various set of reasons that anyone who was a captive owner or manager might want to consider one of these transactions. So I'm going to kick it, I think, at first to Derek here, and I want kind of the panel's going to all touch on various ones of these reasons why, and give a little bit of experience that they might have had with any of these.
Sure. Yeah, I'm happy to start us off, because there's definitely a couple of these that we've been involved with. I mean, I think, you know, in terms of, you know, the captives, you know, I think there was a reference to this earlier. You know, number one in my mind is the first on the list, right? An acquisition occurs where, you know, a new parent is involved, and they simply have a different outlook. They have a different strategy. They may be concerned about, you know, what exists, you know, what the liabilities are, you know, in the captive, and may say we want the acquisition for different reasons. We need to just stop worrying about this. So, you know, looking to a legacy solution provider to, you know, to sort of take ownership of the captive and you know, those underlying liabilities, and allow it to sort of, you know, no longer be a headache or concern. You know, and I think, you know, similarly, but maybe more internal, is the thought of a change of purpose. You know, there are, you know, you think about a situation where you know, you may be you know, operating across various silos, and make a strategic decision that there's a certain type of business and a certain, you know, type of exposure that, you know, we just don't want to deal with anymore. So it's just an internal strategic decision, just to say, you know, let's find a partner. This is a good opportunity, a good time to, you know, kind of start fresh. Let's wall this off, and, you know, find a good partner to help us out with it.
I could add to what Derek was talking about, and for, you know, actually citing examples, we've seen this run the gamut, whether it's an exit from a nightmare, which, you know, we've done transactions where a company wrote workers' compensation that had no business writing it, and they were a health insurer, and as a result, the stock of the company was just suffering because of the business they were writing. We came in and actually acquired their workers' compensation business. The stock shot back up probably 30-fold once that business was removed. So they'd made a mistake in underwriting. They were able to move it off their books, and shareholders appreciated that and were able to see a benefit. Now, that's not necessarily in the captive space, but where I've seen other transactions would be more recently, from the ability to expand and write business without having to raise additional capital. We closed a deal earlier this year with it's actually the risk retention group, but they wanted to start to write different business and they didn't want to go out and have to raise capital from members. So what they did is they looked to lay off very attractive reserves and reserves that were underwritten very well, and were able to get some capital relief in doing so and use that capital to write other business. More recently, the transactions we've been seeing from captives and others and self-insureds have been transactions where they want cash flow. And as Stuart mentioned earlier, having cash or securities tied up in collateral requirements is putting a handcuff on a lot of folks. And so if you're able to lay these liabilities off and have, in a case of a novation, let's say, have a third party stand in your place as a captive as the reinsurer of a front company, now the collateral requirements would fall to us, and we have LOC facilities that are probably more attractive than what a captive might be able to get. And in doing so, we're going to be able to provide a cash flow mechanism. Again, not a nightmare situation, but these are situations where there are other benefits, other balance sheet benefits that are out there.
Yeah, and I'd sort of piggybacking on Michael's, a different example that we see. I think this is kind of a broad, sort of, runoff market area. When I think about certain coal companies, for example, right? There are heavy demands. So a lot of coal companies will self-insure. They may have a captive to protect themselves from certain black lung liabilities or the like. That's something where the government has very high collateral demands. And it's really pretty punitive to the self-insured coal companies. So to be able to turn to the market that has an expertise in this sort of area to be able to get relief, to not have to put so much collateral up, get that returned, is really valuable, because it does really put a lot of pressure on the coal companies in this example. So being able to find an opportunity to transfer that to the legacy market is super valuable.
Yeah, Caroline, if I can just pick up on a couple of the items on the list here. I think the M&A one is probably the one that is most fresh in my mind, because I'm actually working on a solution now for a company which acquired another company. They both had captives, and they clearly only want, to Michael's point earlier on, only one set of costs related to the management of the captive. So we're actually in an active process now to acquire the captive that was left over. The other thing around M&A is that where you have a company that doesn't have a captive and is clearly somewhat risk averse, doesn't want to retain that kind of risk within the group, if it acquires another company that does have a captive, then clearly they may take the view that actually, rather than retaining the captive, they want to get rid of it because they have no appetite to retain that risk within the consolidated group. So I think there's a big part of the M&A activity, and I guess parent company changes, which are largely around the appetite that exists within the corporation to retain that risk on their own balance sheet. So it could well be that a large number of captives may well be surplus requirements because of changes to the corporate entity. The collateral relief, I think we've definitely touched on. The return or redeploy capital, I think, is probably particularly relevant at this point in time, because I think that is why we're seeing, and I don't know, maybe Michael will jump in, but certainly we're seeing a lot of activity in the captive space, because there is a significant amount of collateral that's being tied up. The captive has significant kind of funds that have been sat there that the corporations are clearly now looking to try and free up to support their kind of core operations. So in particular, I think that would be one where people are looking to, can I divest of my captive? Can I put it into runoff? Can I get an economic finality solution that effectively means that I can repatriate this money back to the group? Because I think right now is probably when a large number of corporations may be looking to tapping some of the cash that sits elsewhere within the corporate structure.
I agree, Stuart. We've seen transactions, captives and self-insureds both, where the parent company is actually having financial difficulty. You know, they've had reduced cash flows because of the COVID situation that's ongoing, and they need balance sheet strength. They need help on the asset side, and they have these illiquid assets that are tied up in their captive, and this becomes something that is, you know, a solution for them to actually infuse cash back into the parent company and allow the parent company perhaps to even, and we've looked at a couple that were, you know, on the brink of bankruptcy, that's one of the things that they were looking to avoid by getting additional cash flow back in the back into the balance sheet.
Ken, I do want to be sensitive to audience questions, because we did mention if you had questions to certainly put them in along the course of our chat here. So we did have somebody who submitted a question just saying, can you use legacy solutions for pension risk? So I
Yes.
didn't know if any of the panelists can respond to that.
Yes, they can. We haven't done it, and I think the nature of that is that it's typically, I think at least in Bermuda, viewed to be long-term business, and so typically it would be in the kind of the life space that you would see that. So certainly a large number of the kind of the companies that are based in Bermuda, the Global Atlantics, the Athenes, certainly even Legal in General, have been looking at kind of like pension risk transfer type structures. So there is at least, you know, there's certainly some of that that's going on in the marketplace. It's just unlikely that we are seeing it on the P&C side, just by the nature of the risk and our licensing.
And I see that other question there as well about pricing. So we're going to talk about that a little bit later. So I think we're going to kick that one a little ahead right now. Let's go to let's look a little bit more at kind of like the laundry list of the types of exit transactions that are the next slide, Melissa. A lot of these are, to those of us in this legacy space, sort of ends up becoming the alphabet soup, so to speak, the ADC and the LPT and the IBT. So, you know, each of these have different sort of spins to the way they work and the types of solutions that will work best for you. I think one of the things that is really interesting about the legacy space is the fact that there are so many different variations, different transactions that anyone could choose. Yet again, getting back to figuring out between the parties what's going to work best for your situation. So I'm going to have my panelists each talk a little bit about this various list here, tell you a little bit about what it is and examples of places where they've worked on these types of tools.
I can start. This is Derek. You know, thinking about the first two on the list are the ones that I've seen the most. Adverse development covers, ADCs, and loss portfolio transfers. You know, I think of these as probably the most common. I guess with respect to an LPT, right? So the thought here is, you know, the cedant, the ceding company, they're going to be able to, you know, reduce the future payment uncertainty by taking a block of reserves or a portfolio of reserves off of its balance sheet and sending it to the reinsurer. So the premium, and we'll get into, you know, pricing a little bit later, but, you know, the premium paid to move those reserves, to transfer the uncertainty, it's going to be a function of the present value of the liabilities. So, you know, what do you think the reserves are, you know, discounted, but then, you know, adding something, you know, a risk margin to reflect that, you know, the reinsurer is now on the hook for any future development of those liabilities. I think, you know, LPTs, they're going to protect the cedant from, you know, the deterioration of any, you know, past written business. And actually, that's one important thought. You know, an LPT is, you know, transfer of old business. So this is entirely, looking back, retroactive. They're, I find that they're often used in M&A deals. That they're also certainly, used regularly and just sort of, talked about it earlier, strategic decisions, looking forward as a company might want to, focus on, a different, underwriting focus. It's really meant to kind of, wall off, any, future exposure to losses from any discontinued operations. An adverse development cover is going to do, something similar. It's going to, also, protect the cedent from any unexpected development from the past business. But in this case, it's a little bit different from an LPT in the sense that the cedent will still retain the underlying block of business. So an adverse development cover, it doesn't reduce the leverage, the reserve leverage to the same extent as an LPT. It's going to be priced similarly in the context of looking at discounted reserves, but it's definitely going to be a partial function of the expected timing of the additional losses. I think ADCs typically have a specific dollar amount of protection. When I think of these two, and Stuart, Michael, you should tell me if your experience is different, but I usually think of an LPT as applying to smaller segments of business, a single line of business that someone's trying to get out of, whereas adverse development covers, they typically are addressing larger blocks of business. So these would be common for large commercial carriers, especially in the context of an M&A. One large company is buying another company. They're uncertain about a certain portion of the business might be the casualty book that's been performing poorly. ADC might apply to a broad swath of casualty lines, for example. I don't know if you guys see those as differently.
I would certainly view those two as some of the more prevalent structures that we see. I think just taking a bit of a step back at the laundry list of solutions that we see here, I would characterize the first three, the ADC, the loss portfolio transfer, and the hybrid LPT, as being what I would call an economic finality solution. And then the remainder are what I would call the kind of full or legal finality. So, for people who may not be as familiar on the call, the first three I very much view as you're still on the hook for the original risk that you reinsured into your captive, but you've now bought protection on the back end. And so I think to Derek's point, you still have the leverage, you still have the liabilities on your book, but you now have a recoverable. I think the adverse development cover, the loss portfolio transfer, and the hybrid LPT, I think there's a number of ways that you can structure each of these to either be attaching at a particular point. That may well be your estimate of reserves that you currently have. It could well be that you attach at some point further above your best estimate, which may well be, so effectively provides almost like an excess of loss type protection. So you can maybe view this as, I'm willing to take the next $10 million of loss over and above what I have, and then I want to buy cover over and above that. And similarly, we also see adverse development covers that are attaching below the best estimate. So you're not just transferring the cover for further development, but you're also ceding a chunk of the existing reserves. So I call them the kind of economic finality solutions because I still have them on my balance sheet. I don't get to walk away. I still have to do something. I think the last four are effectively where I want to say, I'm done and dusted. I want to get out of this. I want someone else to take over, and I want to be done with this. Rightly or wrongly, we want to walk away. The commutation is effectively an agreement whereby you sell the liability back to the person who gave it to you. So it's, if I'm going to use AXA XL fronting business into my captive, or Zurich fronting business into my captive, I approach them and say, can you buy this off my hands? Commutations are not solutions that Michael and I can provide, unless we are your fronting insurer, which invariably we're not. So just to be aware, and I'll leave the last three for Michael to talk about, because nobody wants to hear the Scottish lilt droning on for the next 10-15 minutes.
I love the sound of it. So you can talk all day in my book. Yeah, to add on to what Stuart was talking about, even those first three, we've got the word hybrid LPT in there as well. I kind of, to put an example to this, maybe as a way to, do this, we did a transaction earlier this year. It was about $100 million. And so the reserves that were there were $100 million. We did an LPT, which means we took from 0 to $100 million, and we took that entire amount off their balance sheet. Okay. In doing so, they are responsible, and we gave them a limit above that to give them some protection. But all of that cash came off the balance sheet and was transferred off. They're essentially responsible for those liabilities if it goes back above the limit that we gave them. The ADC, if we had done an ADC, what we would have done is we would have attached it 100 million, kind of like a top hat, and would sit on top of this and say, there's the protection. You keep all the underlying assets. We're going to take a little bit of premium, and that's going to be a top hat. What a hybrid LPT does, and you love these, like, this is like so technologically amazing, right? My hands are going up and down. But a hybrid LPT basically says, we're going to step into the reserves a little bit and take some premium here, but give you a top hat on top of it. So it's kind of a blend of the two of those. The commutations, as Stuart mentioned, we can't do anything with really. Novations and sales provide, strict legal finality. A sale is when you basically sell me the captive, and you don't need to worry about it anymore. You don't have any more additional costs associated with it. A novation is something where you still want to perhaps write certain lines of business, but you've got a line of business that you wrote that you don't want to be in anymore, and so you fronted for, you had a carrier that fronted for you. You reinsured them. What we would do as a reinsurer is we would step in your shoes, and that contract would be novated to Sirius, R&Q, whomever, and we would now take on all of the rights and responsibilities of that contract, and you would be able to walk away. You'd be able to clear it off your balance sheet. We would have to post the collateral and do all that. Insurance business transfers are a relatively new animal that's out there. And Carolyn, I don't know if you want to talk a little bit more about those, or Stuart. I know you guys have been in that space and doing some things with those, but they provide finality more on the reinsurance side than they do on the direct liabilities. But if you want to chat a little bit more about those.
Yeah, I can definitely add there. So the insurance business transfer is a new regulatory mechanism that we're seeing emerge in the States. For some of you, if we've got a largely European audience here, you might have heard of a Part 7 transfer, which has been done in the European market for decades at this point. And we've begun to see some of the states here take up passing laws to basically create this additional tool for companies to use. Oklahoma, and I don't know, Stuart, I know there's various transactions right now that are sort of coming through Oklahoma. They've been one of the states that really jumped in very deep and very quickly in this space. There's probably about 5 or 8 other states or something like that along. I have more of that data. If somebody is interested in learning more, we can certainly get you more information on that. But the legacy market in the States is really watching very eagerly to see if some of these transactions begin to come out of the states that do have these mechanisms.
Yeah, and I think just on that, I think, Carolyn, we certainly have an entity within Oklahoma that's set up to do insurance business transfers. I think we have a couple of transactions which will go through or are going through that process. And I think we were all eagerly waiting and watching one of our competitors were, I wouldn't say trialing it through the process, but certainly I think they were one of the most advanced in going through that process. And I think it's either ongoing or it's just recently been completed, but not without its challenges.
Yeah, and I think we're waiting for final approvals. I think it got slowed up a little bit with COVID and the courts being closed. So I think we're looking at sometime around a mid-October timeframe for the final approvals. So, you know, I want to move on. I think it's good just for the audience to hear that on a high level, but sort of getting into the next slide and sort of the process. So, you know, if you do have a captive that you'd like to consider a runoff transaction for, this will give you a little bit of an overview, and each of the panelists will talk about various parts in this process. And you know, the types of considerations. So I think, Stuart, I'm going to kick that one off to you first to address some of this, and then I know both Derek and Mike had comments as well.
Sure. I think the first part of any kind of transaction ultimately has to start with a discussion and an understanding of what the individual wants to achieve. So go back to the previous slide. What are the, you know, is it economic finality that they're looking for? They just want to be protected against further development, or are they looking to exit altogether? Because that ultimately will determine the form of what we can offer to them. It also, to some extent, will also determine the vehicle that we use to do it. Now, R&Q, I'll let, and Michael can weigh in, but R&Q, if we ever end up doing kind of a legacy solution where we need to issue a policy, we have a rated carrier that's licensed in all 50 states and DC that can do that. But it's making sure we understand what is the objective from the party that wants to do the transaction, because that will effectively determine whether or not we're going to go down are we looking at an innovation, are we looking at an LPT, are we looking at an ADC, or do we have to look at an outright sale? So if I take like an RRG, for example, if the RRG issues policies to each individual member, and I have to get each of them to sign off on the innovation, and there's say 50 to 60 members, that may not be the most efficient strategy to go down innovation. I may be just quicker buying the RRG. So, you know, to some extent, the type of structure that it is, the type of transaction, and what their objective is really what drives the type of solution we can offer. And then after that, if I touch on submission, I think a large part of the information that we'd be looking for would be pretty uniform, irrespective of the type of transaction that we do. We invariably look for directives signed off on an actuarial report, so something that's branded Milliman, obviously top of the list. But we would look for a complete loss run for the business. It's be subject to the transaction. That would include both closed and open claims. We want to understand collateral that's being posted currently. And if there's nothing being posted currently, then, you know, what would the counterparty be looking for? You know, the form of the existing reinsurance agreement, any kind of limits, who the current claims handlers are. There's probably around 8 or 9 kind of key pieces of information that needs to be provided by the party before we can actually do something, even to give them a letter of intent.
Yeah, that's a good point, Stuart. And we don't want to sell people what they don't want. So if we don't understand, or if you don't understand what you're looking for, we want to help you understand what you're looking for so that we can give you a product. I think this might be an interesting place to actually talk a little bit, although it's not on here, to talk a little bit about pricing as well, because that is involved in here. The submission, who you reach out to, more than likely for a captive, it would be your reinsurance broker. You might reach out to an investment banker. That's typically where we get a lot of our transactions from. We also hear from service providers, captive managers, attorneys, lawyers that know folks that are looking for a solution, and they point them in our direction. So those would be the folks that you reach out to. Obviously, the panel here, there's some great minds here that would be happy to help you out. The due diligence process can be somewhat cumbersome. The key, I think, is the quality of the data. It's not necessarily the quantity of it, because we've gotten quantity that's just garbage. But when you get good quality data, you can actually do something with it. And the better your data, the more accurate the pricing is going to be, and the less additional work we're going to need to do. You know, we would like to say that we can do things with pretty much an actuarial triangles and a claim listing. You know, financials are also key. If the actuarial data is somewhat flawed and there's inconsistencies and holes in it, then we've got to do a much deeper dive on the claims, and that takes a lot of time, takes a lot of resources. You know, the rest of the process here is once we come to an agreement on price, you know, we execute agreements, and those are the agreements we talked about before, your LPT, your ADC, whatever it is you happen to have there. And from a regulatory standpoint, I would say there's, you know, for LPTs, that's not terribly cumbersome on the regulatory side. On the sales side of things, far more so. You have various regulatory agencies, departments of insurance that get involved and need to approve these things. And we've had sale transactions that have taken sometimes 2 years to close, and just because of the process that happens with this. However, LPTs can be closed, ADCs can be closed much more quickly. I'm going to probably punt over to Derek and talk about all throughout this. Once we get our data, what do we do to actually figure out how much this costs? Because I got to think that's what everybody's primary concern is, and primary question is, yeah, that's all well and good, but what is this going to cost me? And I'll let Derek talk a little bit about the actuarial side of things, and the fact that for us it's primarily a cash flow model. Neither one of us, Stuart, I don't think you guys are a charity. We're not. So we have to make a little bit of money here. So and we have to protect ourselves. So there's a risk premium. So there's a margin, there's a risk premium, and then there's okay, investment income. How much is this thing going to throw off for investment income, and how much of that can we apply to the book to help mitigate some of the costs? But on the actuarial side, I'm not going to pretend to step into Derek's shoes on that. I've done that in other panels. I just don't do it at all. I mean, I have a couple good actuarial jokes, but that just doesn't do any favors.
Well, I know we're getting close to the end, so I'll offer a couple of just real brief thoughts, and Stuart and Michael could chime in from a practical perspective. But when I think of how we contribute to the process, the question for sure is what do you really think the reserves are, and perhaps beyond that, it's can you help us understand, can we appreciate the degree of uncertainty, right? Because anybody coming to these guys is going to have a view of here's what we think the reserves are. They have a loss reserve estimate from their actuary that says this is what we think, this is maybe our best estimate. But I think what's really needed in terms of getting to a price is first what's the best estimate, and then let's recognize the time value of money. We want to, as Stuart's referred to, these are economic deals, so we're going to try to find a price that makes sense for both sides. But the real key is what's the uncertainty? So we'll look at the data, and as Michael points to, the quality of the data is really important, because we're trying to figure out what's the range of possible outcomes, and what do we think the loss levels would be at the 75th percentile, at the 90th percentile, so that we can come up with what's an appropriate risk margin based on what we understand about the book. And sometimes that's something that we can do using the actuarial data. We can produce a stochastic model. Other times, as Michael says, if the data is poor, if the quality is poor, then it involves a lot of side-by-side work with the claims folks. Tell us about what's in this, and what's making this so unappealing that you want to hit the eject button. So getting a sense of the best estimate and certain probability levels beyond that, I think is the number one key. All of these types of deals have other features that need to be considered. I think the folks at Sirius and R&Q are going to want to protect themselves to a certain degree, so there may be sub-limits that need to be considered. We need to factor that in, but with just over 5 minutes, I'll wrap it up there. But I think the key really is can we help to determine the appropriate risk margin on top of the best estimate, because that's the stickiest part, I think, from our end, and then considering other niche features, because all of these are tailored, as the guys say. What exactly is the concern? These are highly tailored deals depending on the needs of the cedent.
Yeah, I would agree. I mean, the idea of, four basic principles we look at: volatility, how much volatility is in the reserves, and that's going to be a price driver, a dramatic price driver. Investment yield, what's the investment environment? In an environment where you're making 6% on your assets, which we haven't seen in years, or an environment where you're making 3/4 of a point on your assets, that's going to affect pricing dramatically. The cost of capital. What is, our cost of capital? What is someone else's cost of capital? Somebody has a higher cost of capital, their pricing is going to be higher. And then ultimately it boils down to a cash flow model. We put these into essentially a cash flow model and say, okay, when do we think these are going to pay out? These reserves are going to pay out. When do we need these assets? And what type of margin do we need on this? It's not, I don't want to minimize what it is we do. It's not terribly complex, but there is some elements to it that, when you look at it, you say, well, why can't you just take my reserves? You'll make investment income on them and walk away. Because there are some liabilities that are far more volatile than others. It's interesting to note with something like workers' compensation, you would think that's a terribly volatile book of business, but all of that happened in the past. It's not like a hurricane that's coming up the Atlantic seaboard tomorrow that could create all sorts of damage. All the known claims for the most part are out there. You're not going to have you may have a new claim come up, but it's not going to be that dramatic. And so that would technically be a little more stable than something that is, rearing its head, let's say, like some of the molestation claims or things like that are far more problematic now, that, where volatility could be off the charts.
Yeah, and sort of tying those thoughts to, I think one of the initial questions was, do firms use similar models? Do the valuations, vary? And I'd say there's high potential for varying views on the price, because of the uncertainty with things like Michael talked about, molestation claims. When will those emerge, and what will the courts decide? It's very difficult to figure this out. So as Michael says, the model is functionally just a cash flow model, but the trick is, what will the levels of losses be? When will they be paid? And those are they represent a ton of uncertainty, which is what will drive different views of price.
Yeah, Carolyn, I'll weigh in very briefly in that, because I'm conscious of the time. But
yeah, and we do have some audience questions as well that I want to make sure. Okay. So I think there's some good questions that have come in. So
invariably, you may have a differing viewpoint between your claims team and your actuaries, which may, to some extent, drive, how comfortable do you feel with the claim view versus the actuarial view, which could potentially impact on pricing. And in the same way that most actuaries will not have the exact same view of the world in terms of reserving, different legacy players will have differing viewpoints as to what they want to, or what they think they need to charge relative to the volatility in any particular book. And I'll stop.
Yeah, and I had Nick and Melissa go ahead and put up the questions that have come in, so that we can address those. And I think Nick also had just indicated that if we go slightly over, we're okay. We might lose some of our audience, but we can certainly try to address the questions. So we hit pricing a little bit already. I think that's that question in the panelist view: what parties are needed to advise on a runoff deal to satisfy due diligence while balancing cost efficiencies? I think that's a good one. I don't know if what of you would like to take that.
I think Mike mentioned brokers are probably the kind of key point. One, they have probably all the information that you need for kind of diligence submission at their fingertips. They're well connected with the legacy players. That would be as a minimum my suggestion, that they reach out to the broker, and then they can just add any advisors as needed for any kind of legal complexities and the like.
Yep, and all the big brokers are involved in AROC as well, some of the big ones as well as the small ones. And so part of it with them is making sure you get the right sort of expertise and the right folks within the brokers to work with you on that for sure. So let's look at the next one. Assume 1 to 3 acquisitions per quarter. Can liabilities be addressed by a series of runoff transactions versus migrating liabilities to the parent platform?
Yeah, I mean, there's a variety of ways to look at transactions. As I understand this question, at any rate, you can take all of your liabilities, group them into one big bunch, and try to move them off your balance sheet, or you can do more of a transaction that is I guess would be similar to like a reinsurance close type thing. So as you close out certain years, the greener years are more difficult to price because there isn't a lot of data that's out there. But from the standpoint of kind of having a rolling type transaction and rolling type solutions that are out there, that's definitely doable. A lot of that would depend on the type of data you have, what the liabilities are. The question is somewhat vague, so it's difficult to give a specific answer to that.
One of the things I always like to tell people just to help them understand sort of yet again, the creativity, but also sometimes the complexity of the market is when you've seen one runoff transaction, you've seen one runoff transaction. So to sort of talk about, everything we've addressed here, that yet again, there's pretty much solutions that can get to, multiple transactions per year, 1 to 3, or any combination of in there. I guess the next one, who applies for the regulatory approval?
I would have said depends. I typically try and get to whoever has the best relationship with the regulator. If you're looking for regulatory approval in the state of for us, are we targeting a company that's in Cayman or a company that's in Vermont? Well, then we're probably going to leverage the pre-existing relationships with that regulator to the maximum extent because it just facilitates the process. So that would, my suggestion is whoever can get it done quickest.
That's true. I think in the case of, in the case of an acquisition, there are certain forms that need to be filed and certain parties need to file those forms. So the buyer would definitely need to, file certain forms if there's change of control and that type of thing. But in an LPT situation where it's more of a reinsurance agreement, we've had the case where we both have gone to the regulator and presented our case where we all sit down with the regulator, and as long as the regulator gets on board with it, we generally don't have problems. And regulators, they're not against us doing these things. I mean, they want to find solutions for folks that are operating in their space just as much as we want to get the solution.
Yep, and I think the fact yet again, you see the sort of regulatory interest from more of the states in passing these types of laws. I think that really underpins and backs that up. So I guess there's one more question from the audience. You say there's little issue with new claims against closed books, but what about under losses attaching policies, which today can hit cover written years ago?
I was the one that actually said that, and I would, as a blanket statement, to say that there is no new claims that can arise from books, that's not the case at all. We see that happening all the time. The example that you give there, a losses attaching type situation, that's an occurrence-based policy where that can definitely rise up and happen. The example I gave of workers' compensation, where the policy closed, the last policy written was in 2012. The chance of having a 2015 accident doesn't exist. Whereas, contrasting that against, let's say, a property policy where in 2020 we've seen, the name storms now getting into the Greek alphabet here in the U.S. Those can continue to produce results even while the premium is still coming in. So yeah, there is still, and that's part of the risk margin that we charge. We understand that these are not truly closed books. We say they're closed books because we've closed the premium on them, but they are open in the fact that there can be claims that come in years and years after the book has stopped writing premium.
Yeah, I think part of it is really just how the terms are determined, right? You could say this adverse development cover applies to only accidents through a particular date. So you can ring fence it very nicely to protect yourself as you need. It's really just what do the two counterparties agree to.
I think just in my kind of closing remark, I think there's always a risk that you have claims that can either reopen, well, generally workers' comp claims that would reopen, but ultimately I think you are to some extent placing some degree of reliance on the actuarial methodology to kind of pick up some of that in the IBNR projection.
Okay, I guess that's all of them then. Nick, there you go.
Perfect. Well, listen, that was, I think, hugely interesting. We've done amazingly. We've run over. We've still got 80-odd% of the audience still hanging on to every word you guys have said. So once again, I think thank you to all our panelists, AirRock, and we've got just to mention the company names again, R&Q, Milliman, and Sirius as well, all of whom are up for an award at this year's Captive Awards taking place next week. So good luck all of you for that next week. Thank you, Carolyn. You do a brilliant job moderating these. And I'd like to thank all our audience and our panelists to joining us today. And we'll see you next time. Thank you.
Yeah, thank you all. It was a pleasure.
Thanks very much.
You.
Thank you.